Our next panel, I'm very excited about, will be talking all things money. So I'd like to welcome Richard Carleton, our CEO, Brent Gilchrist, president of JDS Resources, Sandeep Gupta with Pyfera Capital, and James Reid, managing partner of Three Peaks Capital. So we're going to talk about the flow of capital. Where is capital coming from? Where is it going to? And how is it being placed? I wanted to start off by, I'm having issues with my mic. You can hear me? All right. As long as you all can hear me. We're going to try and get through a bunch of information, but I'm going to try and stop early because I'm sure that there'll be lots of questions for this panel as well. Firstly, thank you to all of you for joining us today. We have Richard, who's traveled from Toronto, Sandeep, who's come up from Vancouver, James, who's come from Vancouver, and Brent, who lives here part-time. So I wanted to start actually with you, Richard, if you don't mind. I just want to talk about how ESG is affecting the flow of capital. What are we seeing from an exchange level? So at the CSE, what are we witnessing as far as ESG coming to the market?
Well, I think there are a number of issues, and the first one was touched on in the last panel, which is there is a live conversation right now with the securities regulators across Canada in terms of the mandatory reporting on carbon emissions, and which is in parallel process in the United States. And that's something that people have got to watch very carefully, because a lot of these standards came from or were developed or inspired in markets that have no resemblance to Canada whatsoever. Canada is unique. We have a massive number of small companies which come to the public markets across a very wide range of industry sectors. There's nowhere else in the world with the diversity and the richness of the early stage capital market in Canada. And they just don't have the wherewithal to support the same kind of reporting that Suncor could be expected to do. They don't have the access to the expertise, the consultants, the full-time employees to do that. And so in measuring how we move forward on this, we have to be very careful to come up with a regime that, yes, enables people to compare and make better choices and exercise, in effect, their democratic privilege in the capital markets to vote with their dollars. But by the same token, we don't want to be killing the innovation, the energy that entrepreneurs bring to the Canadian marketplace, as I say, almost in unique fashion. It's great to see companies like Seth's coming up with approaches that are tailored to the needs of the micro and small cap industry. I will go out on a limb and make a prediction that, notwithstanding the fact that the SEC will pass its sweeping carbon disclosure requirements in the fall, they will lose the inevitable court challenge in the Second Circuit Court of Appeals, and there will never be a mandatory carbon emission law in the United States that sticks. At least not in my working life in the capital markets. That raises some interesting questions for Canada, because there is potential arbitrage between Canada and the United States. My friends at the BC Securities Commission tell me, oh no, we'll take care of the issues as between private markets and public markets, because we'll make the private companies report as well. Yeah, okay, that's great. So, as I say, that's something that people should be paying a lot of attention to, because this has the potential to impact things either in a positive or an extremely negative way, depending on how the regulations come down.
Reporting is expensive, right? So these additional requirements can be a hindrance. I'd like to move to you next. Sandeep, maybe first of all you can tell us about Pyfera Capital and why you're joining us here on stage today. And then I wanted to ask you from the same element, because you're obviously bringing companies to market and financing companies where you're seeing the flow of capital come. You've been doing this for a very long time.
Okay, thanks, Anna. Okay, so a little intro. Career one, Silicon Valley, tech exec, 25 years. Right place, right time. 5 startups, CEO, co-founder, exits. My last gig was managing director of Broadcom, which is about a $350 billion semiconductor company now. Retired, Mr. Dad, and second career, 10 years, venture capital in sustainability. That's what you mean by a long time. First fund, Pyfera Growth Capital. We've syndicated about $100 million in Series A clean air, food, water, energy, circular economy, decarbonization, good health, 8 SDGs, 3 publics so far. And we're hoping, the reason I'm here is to get the capital markets involved more in sustainability. It's a scary world, it's a greenwashed world, and it's very confusing because E is what we focus on, but S and G come in for the ride and they confuse everything. So, second fund is Carbonet Capital, which we're launching now in Europe and Emirates, and it'll be later stage, and we hope to deploy in the hundreds at that point. There's a lot of capital, as you know. Now ESG has potentially 4,000 funds, and the count is somewhere between $1 to $2 trillion at play. 80% of them are in Europe. They're about 10 years ahead of Canada. That's been said before on the stage already. And then the third thing we do is Max Global Repairs is a business development and IPO advisory firm focused on clean tech. Why are we here? 30 years, look, we've known for a long time that we're on a bad path. Tanya, others have said it earlier this morning, we know it. But for some reason, emissions are up 3 to 7% every year since the 2015 Paris Accord. Not a single country has met their emissions goals. 100 companies, we talk about big company and small company, reporting standards. And there was a question asked, but it wasn't answered in the previous panel. You know, after reporting, what next? How does that create change? Well, 100 companies account for 70% of the world's emissions. I'd rather be in 100 boardrooms than, you know, going after 10,000 micro caps and small guys just trying to make things a little bit better. So I'm
Is
here.
that true? 100 companies is 70% of our emissions?
Yeah.
That's incredible.
Yeah. So it's pretty focused. We've known for a long time emissions are up. Finance can change the pace. And there was a couple of people earlier this morning said it's really about timing and pace. So hopefully I'm here to hopefully accelerate before we run out of time.
You said something interesting last night, actually, when we were talking about this, that it provides an opportunity to weed out a part of the sector for your business practices. Can you define that a little bit more?
Well, you know, you heard Sean say we get 1,000 pitches a year, and then there's a lot of people who are interested in doing good, but they don't know how. And if they figure out a way how, they don't know how to report and measure their how is better than other people's. We don't have a single IRR, EBITDA, and ESG. We don't have that number. So
Will we ever, do you think? Is that measurable?
No. In E you can. In S and G it's very difficult. I love, you know, ISO 37000. I love B Corp. All the stuff that's happening, but it's super confusing.
Yeah.
And your average CEO, you know, he's already overwhelmed.
None of our CEOs are average.
No, okay. Your everyday CEO is.
But they are overwhelmed.
They're overwhelmed. Okay. So no, we won't get there quickly, but we intrinsically know. Well, I'm not. So it's a quick show of hands, if you don't mind.
Yeah, please.
Yeah. How many people know that we've crossed 424 ppm? Okay, so this is an SRI. Three, four. So this is an SRI conference. Can I get it on stage? So you didn't raise your hands, but I'm sure these guys know. These guys know.
And who's counting?
Yeah.
Who's counting?
Yeah.
400 to 425, who's counting?
So Brent will have a different perspective, but you know, this is an SRI conference, yet a number that we should know. While we're talking about reporting more numbers and more metrics, a number that we should already know, which is available anywhere, is not yet well known.
Right.
So I think there's enough about me.
Okay, James, I'm going to move to you next. I'm saving you for last, Brent. James, why don't you tell us a little bit about your company? I know that you have a capital company, but you're also starting a fund. Tell us a little bit about that.
Yeah. So, hi guys, my name is James Reid. I'm a managing partner at Three Peaks Capital in Vancouver. I'm a chartered accountant by trade, turned sell-side research analyst for 5 years, then moved on to the institutional sales desk for 5 years, and then 2021, I started my own merchant bank and capital markets advisory firm called Three Peaks Capital with 2 partners. And why I'm here, I think, is because we've made it a mandate at Three Peaks to find, finance, and structure transactions for companies in the energy transition and clean tech spaces. So one of our core files is probably the best performing carbon credit streaming company that's gone public so far. And we also have it's not a fund technically, it's an investment issuer that I'm the CEO of, and that we founded together in 2021. And we will be listing it at some point, hopefully on the CSE, closer to...
James, do you want to explain actually what an investment issuer is? Because I think they're quite neat formations.
Sure, yeah. So an investment issuer is it's a private pool of capital that is raised for the express purpose of making venture type investments into a given industry. And for this we have chosen sustainability because we really do believe it's the biggest opportunity of our generation right now. And yeah, that's why we did it.
I quite like them because I think especially in emerging sectors, it gives an opportunity if you have a good management team, the ability, because everything is brand new, you're not quite sure what's going to stick, so it gives you the ability to go and invest in multiple areas of the sector, right?
Yes, exactly. Invest in multiple areas, spread your bets, and also you're there to provide guidance and advisory.
You're an active investor.
Yes, exactly. So I think it's a small but valuable piece of the capital allocation ecosystem for smaller companies.
And it allows the investor to allow you to go and do all the hard work and...
Yes, exactly.
Okay, so in kind of building this investment issuer, what has been your experience? Because your focus is going to be kind of with this mandate. What's been your experience? Has there been a shift in the capital markets? Is there a demand for this?
Yeah, well, there's always a demand for money, first of all. So that's kind of a constant through time. I think what's been quite interesting, and since we started Sustainable Capital Corp, which is the investment issuer, in 2021, I think the whole ESG and sustainability practice has kind of gone from a state of what I would call like hype and dogmatism to pragmatism, where it was kind of gospel. It was the hottest thing on the street, and it was really more of like a rules-based, zero emissions at any cost, and do whatever it takes to get there. And I do think over the past 2 years, it's definitely morphed into more what I would call pragmatic, so ESG pragmatism, which is, what are the practical realities of the world that we live in right now, and how do we get from A to B without major disruption to the economy and to society. So it's been great to see new business models evolve, and companies that really try to tackle the problem at hand instead of adhering to, here's what you have to do because it's the right thing to do, I guess is the best way to put it.
And what kind of sectors are we starting to see come to the market? So you are engaged in, I believe, carbon offsetting. Are we going to see that as a sector coming to the capital markets?
Yeah, absolutely. I mean, it kind of tried to, and then had a bit of a false start. So we are very bullish on the carbon markets. I mean, there's been a ton of bad headlines. To date, the CEO of Pyfera stepping down because they were selling what were deemed to be junk offsets, mostly in the nature-based, so the forestry projects. But one thing that a lot of people don't realize is that the volumes in the voluntary markets are up 40% year on year, right? So and I think it's really gone into more of a hunt for quality instead of anything. So the end markets are becoming more discerning, which is a good thing. There's also been some, high profile private transactions. I think JP Morgan paid $250 a ton for 800,000 tons in a carbon capture type scenario. And then also another thing we're seeing, and we're actually very, very bullish on, is the whole carbon tech aspect of things. So it's taking, I'll just allude to the previous panel, all the pain points they're talking about with these companies and the onerous reporting and all that kind of stuff. There's a whole ecosystem of companies that are taking that and turning it from a cost center sometimes into a profit center, or at least taking a major pain point and doing their best to minimize it. You know, and I think it's like the perfect type of industry for tech to come in and do its magic.
Okay, one last question before I move along. What are you seeing from the senior markets to the junior markets, or the senior to the growth startup? Are we seeing a change in both sides?
Can you elaborate? Like,
are you seeing a lot more money flow on the senior side, or are we seeing the money flow on the junior side as well?
yeah, I mean, the junior side's been very, very tough, and that should be no surprise.
Well, the markets have been tough.
Yeah,
so
yeah,
we'll
the
say
markets
this
have
with
been
that.
tough. Yeah, exactly. So I won't expound on that. You know.
The fact that you also want to invest is fantastic.
Yeah, but I mean, one thing I will say is that venture as a whole, funding was down about 35% in 2022. For emissions and carbon tech, it was flattish. So, you know, down about 2%, which is kind of negligible in my opinion. So there is definitely private capital out there. You know, TPG just spun up $1 billion fund to invest in the energy transition. And there's also tons of activity from what I would call like industry and corporate and strategic buyers, just to get a foothold in the sector and kind of back technologies that will help them down the road. So it's not all for naught. It's not all doom and gloom. And I do really think that, you know, looking out 5 to 10 years, it's going to be, you know, it's going to be a much different ecosystem than it is right now.
Absolutely. Thank you, James. Yeah, go ahead.
So, not because I'm more knowledgeable than James, but I just happened to be flipping through some slides this morning on your question. So, a slide we used a few months ago in one of our decks was you could buy the entire materials and energy market in Canada for the price of Facebook, for the market cap of Facebook today, and have $300 million left over. But we know what great things Facebook's done for the world, so that's okay.
That is a very sad stat. Okay, so Brent, now it's your turn. Why don't you introduce yourself and talk about JDS Mining? We're gonna focus on, I think, ESG. The first core understanding of it really did apply to the mining sector. So I'm very intrigued on how you're implementing ESG or you're financing ESG. But tell us about JDS first.
Sure, thanks. So first career, I was a hockey player, retired in 2003. Was in the investment business with Dominion Securities here in the Okanagan, and one of my friends, the founder and CEO of JDS Energy and Mining, was bugging her to come and work with him. And so inside the company, we started a venture or a resources company called JDS Resources. And really our goal is we had a great team. We had tools that were consultants to the mining business. We were engineering focused by trade, not me, but the company. Engineer studies, and we build mines. We built the last 3 gold mines that started up in Canada for customers. But my sort of job is we invest money. We try to buy our own projects, typically in Western Canada. The Yukon and the BC, really, Yukon and BC are our specialties. So we built 2 projects in the last 6 or 7 years and sold one and still own one today. And also we have a fund. We partnered up with Dean's Knight Capital, which is a long-term money manager out of Vancouver, small cap, quite resource focused over their history. And they wanted to start just a resource fund, and they came to Jeff and I, our founder, and said, would you partner up with us on this fund? And we thought it was a great idea, and really our goal is to build Canada, to build the resource sector in Canada. We're the best in the world at it, and we have to start financing ourselves. I was saying to my wife this morning, do you know the Canadian pension plan, all of our money? How much do you think of that is invested in Canada? Anybody got a guess?
2%.
No, it's 14, but good guess, because 3% is the world GDP, and I've seen articles on that, but I looked at the report today. It's 14% of our money is invested in Canada, and it's less than 10% in the equities, because a lot of that is Canadian government bonds. So let's call it 9% of all of our money is invested in Canada, and the rest is elsewhere. Now, I'm not saying that's bad, because we want good returns, but apparently, we don't have enough entrepreneurship, we don't have enough great companies, and that's only going to get worse because CPP is also on that ESG fence of, are they going to invest in oil and gas and in mining? Are they going to move, like some other pension funds, to reduce that? Well, I don't want my money in there if they do. So anyway.
Okay, so one thing I want to chat with you about, and this has come up a lot in our discussion, is that ESG programs in Canada, so it's wonderful if our mining companies and exploration companies have developed ESG programs, but just being somebody who engages in the mining sector in Canada, you already have the highest standards of ESG of anywhere in the world, right? So just by the fact that you are a Canadian explorer miner, you're outbeating on a global level and at a global scale. Are we seeing attraction from capital coming in from a global perspective because of this? Is this being recognized, or is there a premium on it?
Well, I think so. We attract a lot of capital, particularly in exploration. Worldwide, the most exploration dollars are raised here in Canada and spent here in Canada. I would say this, and I think first of all, I agree with the panel. We look at things from a different lens, but we are in agreement. I'm an environmentalist. I don't know anybody who's not an environmentalist, whether it's oil and gas, natural resources, or tech. We're all trying to make less impact, but we're all trying not to kill half the world on our way to do it. So just to qualify, I'm an environmentalist. From the mining standard in Canada, I can tell you that your drinking water here in Kelowna has more arsenic than I'm allowed to discharge into the environment from a mine site. Because we have aquatic standards in a mine site in British Columbia. So when we discharge water, we treat it. And if there's, I use arsenic because it's an easy one, everybody recognizes it, but there's selenium. There's a lot of things that come from a mine site because it's heavy metals. That's what we're mining. So it was always there. We capture it in the water. We have to treat it. But Okanagan Lake has more arsenic than what we are allowed to discharge off a mine site in the province. And I just wanted to say that to you because the environmental standards that we operate under are the best in the world, but we also export those to all the Canadian companies mining and oil and gas around the world. And that's a good thing. I'm happy about that. So this ESG, word, and I know Sandeep has a little disdain for the social and governance because he works on something different. But the fact is the mining business and the oil and gas business in our country, you think we woke up when Larry Fink at BlackRock and Wall Street decided to say ESG scores? It's insulting. First Nations engagement, the mining business employs more First Nations in this country than any other industry. Okay, so what we've done in this country and we export it is fantastic. And the construct of Wall Street, actually, it offends us. And we've been doing this a long time and we're getting better. Listen, 30 years ago it wasn't the same. 40 years ago it wasn't the same. We've progressed and we're getting better. And we have to celebrate it.
Do you want to maybe tell our audience, just for those that don't know, a little bit about reclamation standards in Canada? Yeah,
so and this is a really hot button issue right now because we have a lot of abandoned sites in the country. So we have INAC, which is a federal government ministry that is charged with doing that. But the politics that surround that and the science that surrounds that is really frustrating. We're not reclaiming some of these old sites fast enough, and it's not very complicated to reclaim a site. And the only thing that really matters on a site is the water, because acid generation from rock or from the minerals that you have mined that are left in the tailings pond. So what we have to do is we have to contain the water, and then we have to treat it. And beyond that, you can grasslands and everything, that's great, but it's about the water, and we're not doing it fast enough in the country. And that is a black eye on the past, for sure, of the resource industry, but that's what we knew 100 years ago, that's what we knew 50 years ago. We know something different today, and we have to move faster on that. But the new standards, so if I want to build a mine in British Columbia, before I even build the mine, I have to have a reclamation and closure plan already completed. And that's complex because you don't know exactly how your mine's going to, you know how it's going to look because you've designed it, but you don't know all the environmental impacts of what's going to be in the water exactly, what's going to be above the standards. So every 5 years, as a mine site in the country, you have to redo your reclamation and closure plan, and you have to post a bond that says, I have enough money here to do this. If this company, because a lot of times it could be a small mining company, if this company goes bankrupt, there's already money posted with the government to pay for that reclamation.
And is that unique, or are reclamation standards similar in other countries?
Well, it's unique, I would say, to Canada. Ontario and Quebec, who are great mining jurisdictions wouldn't be different. Alberta with, you know, their abandoned wells, they're working on the abandoned wells, but the standards forward are certainly addressing that. The United States is a bit different. They have, you know, the super funds and some of the jurisdictions are different, but lots of abandoned sites. But it's almost impossible to permit mine in the United States of America. Even Joe Biden, what he says, don't believe him. There's no permits coming to the United States.
Permits, dirty word. Okay, this is a question for all of you guys. So I just want to have this conversation. I think we could probably float it all in together. But this idea of the flow of capital in private versus public companies, as well as, and I think if it's private, typically it's more institutional money that's coming towards it. There's not a lot of retail money that flows to the private space. And in the junior and startup space, we see a lot more of the retail. So Sandeep, why don't we start with you? What are you seeing right now? Are you seeing a drive towards the private, or are people wanting to take this to the public markets?
Yeah, actually, 2022 was a very sort of pivotal. Prior to that, obviously the listings were strong, capital markets were strong, ESG hadn't been politicized yet. 2018, the IPCC report had just come out. So we were seeing a movement of institutional capital into this sector, private and public. But now it's mainly private capital, family offices. There's obviously the capital markets that are taking a breather right now.
Are the family offices Canadian or more global?
Well, we're in Canada, and I'm a Canadian, but I am now 6 months in Europe and Emirates. And there's a reason for that. So, Singapore, Hong Kong, London, Dubai, not Frankfurt, by the way. London, Dubai, not Frankfurt. Not Tokyo today. Not New York as much today. Canada isn't yet on the global stage. Definitely mining. We see a lot of capital on all the exchanges coming in and out of the country for mining, which is fantastic. We need mines, and we will need them for the next centuries. It's debatable, how oil and gas is going to transition. It's debated, but mining we know we need. But capital right now is flowing from family offices, and they are claiming, because I spent 6 months over there, every meeting they have more money than deals to put the money in. Now, when I come back to Canada, it's a flip. More deals than capital. So there's a global separation.
There's a shift.
Yeah. And I think the other observation is that, and we've seen this kind of forever, and that is that generally speaking, the private investment pools are significantly less, they have a lower risk appetite than what you would see in the public markets. I mean, that's why these companies go public. It's not a case of taking 3 meetings and filling your book with family offices or private equity investors. It means that you're going to have to try to identify a lead investor who will draw on a large, generally speaking, retail audience from Canada, the United States, and overseas. I mean, again, we know the gold guys for years that in the Germanosphere, there seems to be an unlimited appetite for Canadian gold exploration companies. Just there is. So again, and the oil and gas space used to be in the public markets because it used to be risky. Now the geology is so good, it's very much a private equity game because people can predict in advance, before the hole's in the ground, what the flow rates, the distillates, and in effect the economics can be modeled with a high degree of precision. That doesn't go to the public markets anymore. The only oil and gas deals that we see are ones that have got some hair on them politically, and I thank God for the entrepreneurship of the people running these companies, but we have a successful gas company which is now in production in the Black Sea off the Turkish coast. So they're watching World War III play out overhead on a daily basis. And then one poor guy who used to work for Shell in Nigeria, Shell decided to hell with Nigeria, they were leaving, and put their claims, their leases up for auction. He bid with a Nigerian partner and started into production, and the Nigerian government said, oh, this is a really good looking project, and nationalized it. So again, that's the kind of thing that you see in the public markets, again, because of the risk profile.
Right. James, what are your thoughts on that?
I would just add one more thing, and that's that kind of, whether you're taking money from the public markets or the private markets, there's kind of one constant in this particular space, and that's the plethora of non-dilutive capital that's available for these types of companies. You have IRAP grants, SDTC grants, SHRED funding. Here in BC, there's the BC Venture Tax Credit, a 30% tax credit that you get if it's a qualified BC company and a BC investor. So it essentially subsidizes your valuation by 30%. I remember we sat down with one founder, it was about a year and a half ago in the clean tech space, and this very impressive young fellow had raised $3 of non-dilutive capital for every $1 of equity on his cap table. And I just remember thinking, like, holy smokes, how amazing is that for your shareholders?
Yeah.
Right? So I think when you're looking at these companies and just thinking about the opportunities set ahead of them, it's a really important question to ask, like, what is your plan to avail yourself of this, because it's so shareholder friendly. I mean, some of it comes with hooks and bells and whistles and stuff, but it's something that kind of behooves you not to at least look into. Not to mention that $60 billion in the last Canadian budget, the $400 billion from the IRA in the States, and the $270 billion in the EU's plan. It's not going to be available to every company, but every company should have a roadmap if they're operating in this space to do it, because you really can't afford not to.
You said something interesting there, and that's investor friendly, and I think that might be what is holding some of the capital back in the market. Is there as much upside if a company has this as a mandate, if they have a developed ESG program, if they're socially responsible and build out proper relationships and governance, which I think governance is a big part of kind of the small cap space. But do you think that maybe that's a bit of a barrier to entry?
For companies to get this type of funding?
For the flow of capital to come in?
I think, yeah, I mean, I do think it is. I mean, I think it's, it's kind of gone from, ESG's kind of gone from, a marketing buzzword to something that's, that's a bit of a must-have. And it's kind of stayed true over time, right? Like if you have bad governance, a company has a higher chance of making poor decisions, which will put it into, trouble or disrepute or whatever. And if you're doing things that are bad for society, there's pitfalls, there's headline risk, and information travels so fast now, you really can't afford not to have a good social program. So I think it's, it has become a must-have, but not all companies have it yet. More than just paying lip service to it or having it on your investor presentation.
Right.
Yeah, and I was going to say, it's actually putting it in a positive light. It's an opportunity for a management team to stand out from their peers. Because if you excel at these issues, chances are, as you say, you're going to make better decisions, you're going to allocate capital better, and the company will be a better managed operation.
Absolutely. I'm going to finish off with one question for all of you, and then hopefully we have a few minutes for questions. Brent, I'll start with you. And obviously you come from the bent of the mining space. But what is next to come in the mining space when it comes to ESG? What would you invest in, or what do you invest in?
Well, I mean, we spend time with the company. I mean, first of all, we have 25 companies in our portfolio, and there's not one of them we don't know the CEO and the CFO that we haven't sat down with and had coffee. Maybe during COVID there was a lot more Zoom and Teams meetings, but that is more important to us. We can open the page to their ESG report, and it's not like we wash over it. But I think some of the companies we own in Canada, your guard's down a bit in Canada on the ESG. Because of the standards we from whether it's social or governance or environmental. But we own companies that operate gold mines in Ecuador, and you have to watch that. And you do actually, for us, it comes back to people. Like the Lundin family operates a gold mine in Ecuador, and we know those folks well. We know the Lundin sons, and we sit with them. We know what they're all about. And so, from most investors in this room, they don't have that access. And
I was going to say, most of us don't hang out with the Lundin.
No, it's the mining business, and they are kind of the mining business in the country. So, and so we have access to that, and we follow what they do. I mean, we had a gold mine, a company that owns many mines around the world. They have a gold mine called Filo de Sol in in Guerrero State, Mexico, which is, you know, the most dangerous state in Mexico, and they've had terrible problems with the cartels. And we ended up making a decision to just sell the company, and it wasn't the company's fault necessarily, but the governance they were going to, I mean, it was, what were they going to have to do to operate their mine? I don't know. So we didn't stick around to find out, but you know, we spend time on it, but we, to be honest with you, spend 80% of our time on the opportunity to make money. Because the fund is absolutely useless unless our investors can make money. We'll do no good just by losing money and investing in something that has a bent of perfect ESG.
Pay attention to the smart money.
We try to.
Yeah. Sandeep, what about you? What are you investing now? What would you invest in next? Or what would your advice be to an investor?
Well, we're pretty focused on air, food, water, energy, decarbonization, circular economy. So those are the SDGs. You know, construction. You know, 65% of the city's emissions are from buildings. It's the second largest industry in the world, $12 trillion a year, and it's expected to double every decade in the foreseeable future. There's 8 billion people, and we have a global housing problem, not just Vancouver. So
Tanya talked about that transition that needs to happen, which creates a lot of opportunity from an investment perspective, right?
Yeah. So construction is one. Energy, right now, 18% of the energy mix is electrons. That's expected to be 50% by 2050. Obviously, it's going to come out of thermal and hydrocarbons, but and not only is the mix going to triple from 18% to 50% for electrons, but the total amount of terawatt or petawatt hours needed is going to triple. So we're looking at a 9 times need for electrification in the next 20 years. And there's no amount of solar and wind and geothermal and nuclear that can singly meet that demand. So we're going to need a lot of that. So energy, and then of course energy storage. So we're looking at those sort of mega plays, and all across the spectrum, from Series A to late stage, follow-on public issuers. But really, we're hoping that CSE and the Canadian markets, which are, as Richard mentioned earlier, more globally acceptable of early stage risk. Europe and the Asian markets and Tokyo are very, very risk adverse. But Canada, Australia, we love that crypto cannabis stuff. We love that stuff, you know? And so this
Especially the cannabis.
especially cannabis, which was a great horse for CSE, right? So I'm really hoping that Canada can take the lead on early stage go publics in the sustainability sector and be a role model for the other markets later on.
Well, based on our resources that we have available, I think it's our job to lead the way, right?
But also just early stage tech. I mean,
Yeah.
we can list a pre-profitability, some
Yes.
revenue, right? And you can't do that anywhere else in the world.
I think our exchange is the only one that you can do that.
Oh,
Just
yeah.
pointing that out.
Okay, yes. You've got the C in there.
Richard, what would you invest in? What are your thoughts? What's next?
What's next? Well, it actually doesn't matter what we think. No, and I say that. People constantly ask me, so Richard, what's your exchange focused on in the coming year? It doesn't matter. It's what the market is funding, right? It's how investors are voting with their dollars. And so, again, I personally believe, but again, you know, that advice is free and that's what it's worth, that we are, you know, I think as all of the panelists discussed, at the dawn of an absolute explosion of investment in the mining space in Canada. We have to be. If we're going to, what was it, 9 times increase in the amount of in 20 years? Well, you know, again, as I said, as I've been saying often on public podiums recently, we can't just sort of close our eyes and click our heels together and wish all of that copper and nickel into existence. Right? We're going to have to do that. We're going to fund it. We have to build the infrastructure necessary. We have to create the supply chains and get going now.
Absolutely. Thank you, Richard. James?
Yeah, this is not investment advice, first of all. This is just what I'm looking at.
Don't listen to anyone.
Yeah, don't listen to anything I say.
Forward-looking statements?
Yeah, yeah, exactly. I think if you were to stratify, like the things that I'm looking at closest are, number one is the carbon and emissions tech bucket. I think that's got a huge runway. There's lots of money flowing towards it, and it's you know it's an industry that's ripe to be disrupted. And then below that, I would kind of harken back to my comment on the carbon markets. There is tons of opportunity there. It's been a false start to date, but with a little bit of luck and a little bit of maturity and more standard setting within the markets, I do think that it really stands to become a new type of financial instrument that can really help companies unlock a whole ton of value and also accomplish their ESG goals and also turn what is a cost center into a profit center. So, it's something that could tick a lot of buckets there. And then Richard kind of stole my thunder on the third point, but on the point of being pragmatic, right? Like, it's the whole commodity side that you really can't have this transition without the underlying base materials to make it happen. And structural supply deficits are going to continue, and I think that's a good place to be as well.
Okay, could I just comment on their
Yes.
answers? Their answers were a lot better than mine, so I gotta jump back. So, and Sandeep alluded to the terawatt hours we need, and we're at I think we're at 1,900 terawatt hours worldwide, and tripling of that. So, ESG targets, CO2 emission reductions. Seriously? Tripling our terawatt hours? What if we can't? What if we're going down? Are we okay with that? Because I can tell you that mining the materials we need to mine, and I did not disagree with Sandeep when he said it's 425, it's going up. I always have a problem with the accuracy. We're completely precise but totally inaccurate. But it is going up. I agree with them 100%. CO2 is going up. Let's triple the terawatt hours we need in the world. Reducing CO2? Unless we build the flux capacitor, which maybe we can bring the doctor back. So this transition, right? This transition is going to happen. I'm sure it is, because oil and gas are finite. I'm a believer in that. I don't know when, but they are finite. So to have 8 billion people on the planet, it seems to still be growing, not very fast right now, the population. But what if we have to do with 1,000 terawatt hours? Can we do that in the world? And it's a question we have to ask ourselves, because I'm not a conspiracy theorist, but I listen to a lot of pretty smart people, and they're like, where's the energy coming from? Even when you input oil and gas, because we're at 100 million barrels a day today, right? 100 million barrels a day. I just want to give you a cool stat. Barrel of oil, does anybody know how many BTUs in a barrel of oil? 6 million. Come replace it for me. Just come replace that, highly transferable at room temperature, freezing, it doesn't matter, you can transport it anyway. And the labor in 6 million BTUs, you know how much man labor that is? 11 years. 1 barrel of oil, I can buy it for less than $100. We got some big questions around how we're going to make a transition away from this. We are going to have to eventually, because I believe that at some point this won't be with us. But the CO2 reduction by companies telling us they're going to reduce the CO2, I don't know how, unless you're just a consultant. And you're like, hey, look at my ESG score, right? Anyway, 2 cents, but great answers.
Thank you so much. I've taken all the time up as far as questions, but these gentlemen will be sticking around. One thing I encourage people to do when you see these experts and thought leaders on stage and you get a chance to chat with them, ask them what they're reading and what they're listening to. I always find that I get a lot of valuable insight when I get a chance to chat with them about that. Gentlemen, thank you so much for joining me. We could be up here for hours, but I'm going to let everyone go. We do have lunch available if you want to stick around.
Thanks to Anna. She's put on a great show here today.
Thank you.